In 1992, a Toronto couple earning the city's median household income could purchase an average detached home in Scarborough for roughly $215,000. Their combined annual income was around $53,000. The price-to-income ratio sat at 4. They saved for 3 years, secured a mortgage, and owned a house with a yard 15 minutes from the subway. That same house today lists for $1.4 million. The median household income in Scarborough is approximately $78,000. The ratio is 18. The couple from 1992 needed discipline and stable employment. The couple today needs $280,000 in cash for the down payment alone, plus an annual income approaching $200,000 to service the mortgage. Median earners are not even in the conversation. This is not a story about speculation or foreign buyers. This is about a system that once produced starter homes as its natural output and now produces them as market failure. The ladder is still standing. The first rung has simply moved 9 feet off the ground. For most of the late 20th century, Canadian housing operated as a stabilizer. Mortgages required conservative down payments. Interest rates fluctuated, but lending standards held firm. Housing prices rose in rough step with incomes. Between 1980 and 2000, real home prices grew at about 0.8% annually. Starter homes, modest bungalows, 2-bedroom townhouses, older condos, formed the entry layer. Families bought them in their late 20s, stayed 5 to 10 years, traded up as incomes rose. The inventory turned over. Supply met demand with lag, but it met it. The whole structure assumed housing was a consumption good that appreciated modestly. You bought a home to live in it. Equity was a bonus, not the strategy. Retirement security came from pensions and savings, not leveraged real estate gains. This was equilibrium. The system balanced the interests of buyers, lenders, municipalities, and owners without tipping decisively toward any single group. But equilibrium is fragile. The Bank of Canada, along with central banks globally, began a 3-decade march toward lower interest rates. This was not reckless. It was a response to disinflationary pressures and slowing productivity growth. But lower rates increase borrowing capacity without increasing income. A household earning $80,000 annually can afford dramatically more mortgage debt at 3% than at 8%. The monthly payment is what binds. When rates fall, buyers bid higher while keeping payments constant. Prices adjust upward to absorb the additional credit. Canadian households did not suddenly become reckless. They borrowed more because borrowing became cheaper and because home prices were rising. Between 2000 and 2020, household debt to disposable income ratios climbed from roughly 110% to 180%. Much of that increase was mortgage debt. Banks facilitated this willingly. Canada's mortgage system is backstopped by CMHC, which insures high-ratio loans. CMHC insurance protects lenders from default risk. Losses are socialized. If a borrower defaults, the lender is made whole. The risk transfers to the public balance sheet. This creates an asymmetry. Lenders benefit from volume and appreciation. Taxpayers absorb tail risk. Borrowers take on maximum leverage because that is what the market demands. The system appears stable because default rates remain low. But stability is conditional. It depends on continued low rates and continued price appreciation. When either breaks, exposure concentrates instantly on the most recent entrants. Those with the least equity, the highest leverage, the thinnest margins. That group is always the youngest buyers. Municipalities discovered something lucrative. Rising property values inflate assessed values, which increases tax revenue without requiring painful rate hikes. Development charges, fees levied on new construction, became a central revenue tool. In the Greater Toronto Area, development charges on a single-family home can exceed $100,000. These costs are passed directly to buyers. They fund roads, sewers, parks, public goods financed entirely by new entrants. Existing homeowners do not pay development charges they already own. This creates a perverse incentive. Municipalities benefit from rising land values and from limiting supply because constrained supply drives up assessed values. Approvals slow. Zoning remains restrictive. Densification faces resistance from existing residents who vote at higher rates than renters. Council meetings follow a predictable script. A developer proposes a mid-rise building. Residents appear to oppose it. They cite traffic, parking, neighborhood character. Council delays or denies. The land remains underutilized. Scarcity persists. This is rational self-interest. Existing homeowners benefit from scarcity. Their property values rise when supply is constrained. The fiscal model now depends on rising prices and limited supply. Lowering home prices would compress tax income. Expanding supply would require infrastructure investment funded by development charges, which require approvals that existing voters resist. The loop closes. Then population growth accelerated. Canada's immigration levels were stable through the 1990s and early 2000s, around 200,000 to 250,000 annually. By 2022, Canada welcomed over 430,000 new permanent residents. Temporary residents added hundreds of thousands more. The policy logic was sound. Canada's birth rate is below replacement. Immigration sustains labor force growth and improves fiscal sustainability. But immigration increases housing demand immediately. Supply does not respond at the same speed. Between 2015 and 2023, Canada's population grew by roughly 3.5 million people. Housing starts averaged around 200,000 units annually. New arrivals concentrate in Toronto, Vancouver, Montreal, cities with jobs and established communities. These are also the cities where land is most constrained, zoning most restrictive, and prices already highest. Policymakers face an ugly trade-off: reduce immigration sharply, and GDP growth slows and fiscal pressures mount. Maintain immigration without matching supply growth, and housing costs compound. The political path of least resistance is to maintain targets and offer incremental supply reforms that do not disrupt incumbent voters. Every year of delay raises the entry threshold further. Housing stopped being shelter that appreciated and became the primary wealth-building mechanism for the Canadian middle class. Wage growth stagnated. Pensions shifted from defined benefit to defined contribution. Bond yields collapsed. Savings accounts yielded nothing. Housing was the exception. It appreciated reliably year after year. A Toronto condo purchased in 2005 for $280,000 was worth $650,000 by 2017. A Vancouver detached home bought for $850,000 in 2009 reached $1.8 million by 2016. Homeowners came to view appreciation not as windfall, but as financial plan. Retirement security increasingly depended on home equity. Families extracted value through refinancing. The home became collateral, ATM, and pension substitute simultaneously. The political implications became structural. Policies that might lower home prices threatened the balance sheets of millions of middle-class households. Voters who depend on home equity for retirement will not support corrections. The system locks. Housing must be protected because so much depends on it. Banks hold it as collateral. Pension funds invest in real estate. Municipalities rely on its tax base. Households anchor retirement plans to its appreciation. Once housing becomes systemic, it cannot be allowed to fail. But it also cannot be allowed to become accessible again, because accessibility requires price normalization, and normalization would undermine everyone currently inside. Institutional investors noticed. Pension funds, private equity, real estate investment trusts, capital that once avoided residential housing, began entering the market, not primarily detached homes, but rental buildings, multifamily units, condo developments. This is rational capital allocation. Canadian housing is backed by government insurance, protected by political commitment, and generates yield in a low-rate environment. Institutional buyers can outbid individual households. They optimize for yield rather than occupancy. Starter homes, small, low-margin, inefficient per square foot, become unattractive inventory. Developers optimize for higher-margin units. The entry tier gets built last, if at all. Money that might fund productivity growth or business expansion flows into property instead. The economy appears stable. GDP grows, but productivity lags, wage growth stagnates, and national wealth concentrates in land rather than productive capacity. The starter home disappears not from lack of demand, but from reallocation of capital toward higher return segments. A young mechanical engineer graduates from the University of Waterloo in 2019. She secures a position in Mississauga, earning $68,000 annually. She lives with roommates, saves aggressively. By 2023, she has $45,000 in savings. She qualifies for roughly $380,000 in mortgage financing. In Mississauga, the average one-bedroom condo lists for $520,000. A townhouse starts at $750,000. Even with her savings and maximum borrowing capacity, she cannot afford entry-level ownership where she works. She considers Barrie, an hour north. Prices are lower, but her job is not remote compatible, and commuting 2 hours daily is unsustainable. She considers London, Ontario. Prices are more accessible, but engineering opportunities are limited and wages drop $15,000. She did everything the system allegedly rewards. She studied a high-demand field, graduated without excessive debt, secured stable employment, saved diligently. The latter simply is not there. Employment opportunity in Canada concentrates in a handful of metros. Toronto, Vancouver, Montreal, Calgary, Ottawa generate the majority of knowledge economy jobs. Remote work expanded during the pandemic, but as offices reopened, many firms pulled back on flexibility. Young Canadians face a brutal trade-off: live in Toronto or Vancouver and pay unaffordable rent indefinitely, or relocate to affordable regions with weaker income prospects. A software developer in Toronto might earn $95,000. In Halifax, the same role pays $70,000. Rent in Toronto is $2,400 monthly for a one-bedroom. In Halifax, $1,400. The nominal savings are real, but the income gap compounds over time. Career progression is faster in larger markets. An ownership in affordable regions is achievable, but it comes at the cost of lifetime earnings. Neither path is acceptable. Both are being chosen. And increasingly, a third path is emerging: leave Canada entirely. The risk asymmetry is now generational. Existing homeowners bought at lower multiples, locked in equity during appreciation, and benefit from continued price stability. First-time buyers enter at peak valuations with maximum leverage and minimal equity cushion. A 5% price decline erases their down payment. A 15% decline leaves them underwater. Banks are insulated by CMHC insurance. Existing owners are protected by policy inertia. Municipalities benefit from sustained valuations. Pension funds need real estate to generate returns. The only group absorbing unhedged risk is new entrants. The system depends on new buyers continuing to enter at elevated prices. But those buyers are not entering as reliably anymore. Some delay indefinitely. Others depend on parental wealth transfers. Ownership is being reclassified from earned achievement to inherited privilege. The pattern is becoming visible. Canada's housing market operates less like a market and more like a closed system optimized for incumbent protection. Prices rise, credit expands, supply lags. Policy interventions cool things marginally without allowing corrections. Demand resumes. Prices climb further. Every supposed fix preserves the core architecture. First-time buyer incentives do not lower prices. They increase borrowing capacity, which gets bid into prices. Stress tests limit leverage but do not reduce valuations. Yon foreign buyer taxes shift marginal demand without addressing structural supply. The system appears dynamic, but the optimization function remains constant. Do not allow broad-based price declines, because a sustained correction would strain bank balance sheets, compress household net worth, lower municipal revenues, undermine retirement security, and trigger political backlash from the majority of voters who own. No institution benefits from normalization. Every institution benefits from stability at current levels. So the system behaves predictably. It stabilizes prices at elevated plateaus. It resists supply shocks. It accommodates demand through credit rather than construction. It prices new entrants at the margin of feasibility. This is not malice. It is optimization within constraints. The constraints simply exclude young Canadians from the priority function. Japan offers an instructive parallel. In the late 1980s, Japanese land prices inflated to extraordinary levels. When the bubble burst, Japan did not experience a cleansing crash. Instead, banks and corporations were protected by policy interventions. Credit remained tight. Prices declined slowly over decades. The result was stagnation. An entire generation entered adulthood during deflation, weak wage growth, and diminished opportunity. Canada is not replicating Japan's bubble in scale, but it is replicating the structural trap, an economy where asset prices are too important to correct, but too high to sustain broad-based prosperity. Canada's trajectory is slower but structurally similar. Housing prices will not crash spectacularly. They will drift sideways while incomes slowly catch up over decades. But time is not neutral. A generation locked out of ownership loses compounding years of equity accumulation. The system does not collapse. It stratifies. Policymakers are not ignorant of this. Proposals circulate regularly, increase density, relax zoning, accelerate approvals, tax vacant units. Some of these ideas are sound. None address the core problem. The system is now optimized around protecting asset values, and any policy large enough to restore affordability would destabilize incumbents. Increasing supply materially would require overriding municipal resistance, alienating suburban voters. Reducing immigration sharply would slow GDP growth. Raising interest rates aggressively would strain households carrying record debt. Allowing prices to fall would trigger bank stress and political rebellion. Every lever has a cost. Every cost concentrates on politically important groups. So policy remains incremental, small tweaks, marginal adjustments. Nothing large enough to rebalance the system. The political logic is airtight. Voters who own outnumber voters who do not. A politician who promised to lower home prices by 30% would lose decisively in every suburban riding. The system cannot be reformed without breaking something it is designed to protect. And breaking it is politically unacceptable. A 32-year-old accountant in Richmond Hill rents a basement apartment for $1,650 monthly. She earns $72,000 annually. She saves $800 per month. At that rate, she will accumulate a 10% down payment for a $550,000 condo in 9 years. By then, she will be 41. Her parents bought their home in 1996 for $189,000 on a combined income of $64,000. They were 28. They owned outright by 50. She will not own outright in her lifetime unless inheritance accelerates the timeline. This is the structural outcome of the system as designed. If incentives remain aligned as they are, ownership continues shifting later in life. First-time buyers increasingly rely on family wealth transfers. Those without access to parental capital rent indefinitely or relocate. Rental markets become dominated by institutional landlords. Tenant protections remain modest. Mobility decreases. Young professionals face a choice. Accept lifelong renting in major cities, move to secondary markets with weaker income prospects, or leave Canada entirely. Emigration is already rising among educated young Canadians. The U.S. job offers higher salaries and more affordable housing in many markets. Canada loses talent not because it lacks opportunity, but because opportunity is unaffordable. Canada will still attract immigrants, but it risks losing the upwardly mobile native-born population it depends on for continuity. Ownership becomes hereditary rather than earned. The middle class does not disappear. It fragments. The system is not failing. It is succeeding at what it has been optimized to do. Protect existing asset holders, preserve municipal revenues, stabilize financial institutions, and maintain GDP growth. First-time buyers were never part of that optimization function. They are margin participants. Their entry is tolerated when it does not threaten stability. This is not conspiracy. It is emergence. No single actor designed it. Each institution made rational decisions within its constraints. Banks lent because they were insured. Municipalities restricted supply because voters demanded it. Homeowners resisted density because it threatened their equity. Capital flowed into housing because returns were defended. The sum of rational individual decisions produced a system that operates against collective interest. And because each actor is locked into their position, reversal becomes structurally improbable. The choice being made is not between stability and crisis. It is between who stability serves. And for young Canadians trying to buy their first home, that choice has already been made. The price reflects it.